Hello everyone, welcome to Enjoy Audiobook, where we unlock the door to wealth through the power of listening to books. I hope you all enjoyed today's audiobook session. Today, we're diving into The Intelligent Investor by Benjamin Graham, who was none other than the mentor to the legendary investor Warren Buffett. In fact, Buffett used this very book as a textbook when he taught investment courses at university. Benjamin Graham is hailed as the father of value investing, and Buffett himself has said that 80% of his investment philosophy is derived from Graham. He even named his son Howard Graham Buffett in his mentor's honor. However, many might not be familiar with Graham's own investment stories, so let's look at an example to see if it qualifies as value investing. In 1926, at the young age of 32, Graham made a landmark move with the Northern Pipeline Company, which was a spin-off from Rockefeller's Standard Oil. The market value of the company at the time was $2.8 million, but Graham discovered that the company held $3.6 million in railroad bonds. These assets were not reflected in the stock price because the company had frozen this asset, not turning it into profit. Why would a company hide its profits? Some might think these assets were their profits, or perhaps it was a strategic consideration. But that's not our main focus here. Think about it, Graham found this information in public records. Didn't other investors know? They probably did, but they didn't see how to profit from it. Graham, on the other hand, did something different. He quietly bought shares of Northern Pipeline through the secondary market using the funds he managed, and then, in a sudden move during a shareholders' meeting, he challenged the management to sell the bonds, which significantly increased the company's profits and caused the stock price to soar. He then sold his shares at a high profit. This strategy has been emulated by many hedge funds since, but Graham was the first on Wall Street to do so. Does this count as value investing? Strictly speaking, no. In The Intelligent Investor, Graham himself does not encourage this type of profit chasing because such opportunities are rare and generally only accessible to institutional investors with large capital. If retail investors get involved without understanding the full picture, they might be misled. So, although Graham made his name through such investments, he did not recommend this path in his book. In other words, Graham, as a wise man and a once ruthless financial player, wrote a book teaching the average investor how to protect themselves and make profits. Buffett said in the foreword that Graham was a generous man. The Intelligent Investor has been revised 4 times since its publication, and today I'm discussing the latest 4th edition. The book is approximately 600 words long, and I'll distill its essence into 3 questions. What is an intelligent investor? What does an intelligent investor buy? And when does an intelligent investor buy or sell? If you can answer these 3 questions after listening, you've essentially grasped the essence of the book. Let's start with the first question. What is an intelligent investor? A shortcut is to intern or work at a financial institution for a while. The second rule is not to let others manage your business. This is easy to understand. You should be in charge of your own investments. The third rule is that if there isn't reliable calculation showing a high probability of reasonable profits, then don't engage in that business. One way to do this is to write a relatively formal research report for each investment decision. The fourth rule is to have the courage to trust your own knowledge and experience. If you conclude based on facts and know your judgment is reliable, then act on it, even if others may hesitate or disagree. Simply put, be confident and decisive. If you can follow these 4 principles, it's very likely that you have already achieved business success in some areas. If you've always been an employee and never even considered starting a business, then you need to carefully consider how likely it is for you to become an active investor. Graham believes that those qualified to be active investors are people who have money and leisure, as well as a stable source of other income. These requirements effectively exclude most retail investors. However, young people aspiring to make investing a lifelong career shouldn't despair. Graham also said that for young people, it's beneficial to use a small amount of capital to learn and try active investing. But they must understand that they're learners and should not aim to beat the market. Now, let's move on to the second question. What does an intelligent investor buy? The book first addresses a basic issue: whether investors must build a portfolio. Is it okay to put all your money into stocks, or, to be safer, buy gold and bury it in the backyard? The 4th edition of this book was written during the collapse of the Bretton Woods system, with severe inflation brewing in the United States. Many people were discussing what to buy to preserve value. Many experts recommended buying only stocks because they believed that the profits of listed companies would rise with inflation. However, Graham disagreed. From 1966 to 1970, living costs increased by 22%, but stock prices and corporate profits both declined. Moreover, Graham also examined the relationship between gold and real estate and inflation. The conclusion was that neither was very effective at combating inflation. In short, there is no foolproof method to combat inflation. Investors must build a portfolio to ensure their savings do not diminish. The proportion of stocks should neither be too high nor too low. Graham suggested a range of 25 to 75. At any time, the proportion of stocks in the investment assets should not exceed this range. As an intelligent investor, whether defensive or active, you should allocate 25 to 75 of your total assets to buying stocks. The remaining part should be allocated to bonds. Graham briefly introduced some key points about bond investing in the book, which might not be very relevant for Chinese investors considering the different national conditions. Considering the actual situation of China's capital market, the bond part can be understood as low to medium risk financial products, such as the national debt reverse repurchase products launched by the exchange and convertible bonds. Now, let's focus on the selection of stocks. Graham does not agree with the very common view that low risk equals low return or high risk equals high return. He believes this is incorrect. In fact, many investments that yield excess returns carry low risk. The key to achieving high returns is not to take risks but to invest more wisdom. So, if you think defensive investors should buy low-risk stocks and active investors should buy high-risk stocks, you're greatly mistaken. Asset allocation is not that simple. Graham offers different advice for the 2 types of investors. He believes that defensive investors should follow 4 principles when selecting stocks. First, diversify appropriately but not excessively, with a recommended number of 10 to 30 stocks. Second, buy stocks of large, well-known companies with solid finances. Third, the company should have a history of consistent dividends. Fourth, the price-to-earnings ratio should refer to the market average over the past 7 years, which was 25 times when Graham was writing the book. These 4 principles would almost exclude all strong and popular growth stocks. In Graham's view, completely avoiding so-called growth stocks is very correct for defensive investors due to the high uncertainty and risk. As for active investors, Graham believes they should also mainly invest in high-quality stocks that meet the above criteria, but they can also allocate a portion of their funds to buy stocks with stronger growth potential. However, each investment must be well-founded. The book mainly emphasizes that active investors should not now. Let's delve into some areas that active investors should either avoid or approach with caution, which include high-yield bonds, foreign bonds, and newly issued stocks. In short, don't buy financial products that you don't understand and can't scrutinize. Graham also advises active investors not to focus too much on hunting for growth stocks. While it's a viable strategy, the market is saturated with professional investment institutions that have already driven up the prices of truly growth-oriented companies. It's tough for individual investors to get ahead of these institutions. Although a few might firmly hold on to a growth stock and reap substantial profits, they generally have a very close personal connection to the company, such as being an employee or a family member. After hearing so much about what not to buy, you might wonder what active investors can actually purchase. Graham believes that the strategy for active investors should follow 2 principles. 1. It should yield fundamentally robust returns. 2. It should be different from the strategies used by most investors or speculators. These principles are challenging to implement. Simply put, if everyone else can think of a strategy, you shouldn't use it. Therefore, Graham couldn't explicitly tell you what strategy to adopt because once it's written in a book, everyone knows it. Despite this, the book does provide 3 examples of relatively effective strategies at the time. 1. Overlooked large companies with low price-to-earnings ratios. 2. Undervalued bargain stocks, the easiest to identify being those priced below their net current assets. And 3. Second-tier companies within sectors, those that are not the market leaders. In the Chinese iShare market, there are also second-tier stocks that are gambled upon. These stocks represent an investment choice in the stock market, and another important investment product in the stock market is mutual funds. Graham considers funds a good choice for defensive investors, but don't think it's easy to just buy funds blindly. That's not the case at all. Anyone in China who has bought equity-focused funds has likely had the experience of feeling that these stocks are unreasonable because when the market starts to fall, funds lose money faster than direct stock purchases. The same is true in the United States. According to the book, the vast majority of Wall Street funds cannot outperform the index, and this is still the case today. However, this is a normal phenomenon. Investors should not expect funds to perform better than the market average. So, if you really don't have time to analyze stocks, buying funds is certainly an option. But just randomly picking a few blue-chip stocks on the market might feel wrong. There are indeed some funds that have performed well in the last 2 or 3 years, but these are precisely the funds that Graham warns investors to be wary of. They may have achieved above-average performance through speculative actions, which can bring significant risks. Although they have had a few good years, the price might be losses for the next decade. On the other hand, compared to open-ended funds, Graham recommends closed-end funds. Closed-end funds do not require sales charges and are generally sold below book value, whereas open-ended funds have high sales charges, transferring additional costs to investors. Moreover, the influx of subsequent funds can also create management pressure. In China, there's a ready example of this with Yudibao, which now requires queuing to purchase. This is the trouble caused by the large scale of open-ended funds. However, one advantage of financial products like Yudibao is that the internet significantly reduces sales and promotion costs. Thus, Graham's view that open-ended funds have higher sales charges needs to be reconsidered in the internet era. Besides funds, at that time in the United States, two other popular investment products were convertible bonds and stock warrants. In China's iShare market, convertible bonds have become increasingly popular. Since 2017, subscribing to new bonds has become a hot term. Generally, in the first 1 or 2 weeks of trading, convertible bonds can see a rise of 10 or even more than 30%. However, most investors seem not to plan to convert or hold until maturity but only hope to speculate in the short term, which can bring certain risks. Graham is skeptical about the high returns of convertible bonds, believing that this financial product is not as safe as bonds nor does it offer the high returns of stocks, and often neither goal is achievable. The main reason is that the investment method is complex, and not in every situation can the conversion be smoothly carried out. When investors buy, they think, well, if the market price is above the conversion price, I'll convert. If it's below, I'll hold the bond to maturity. But due to various traps in the contract, often the returns you end up with are not even as good as ordinary bonds. As for stock warrants, Graham's view is even more negative, considering this financial product too speculative. Our iShare market has also introduced warrant products, which led to crazy speculation and caused a large number of investors to lose everything. So, they were quickly halted by officials, indirectly confirming Graham's negative view of warrants. With this, we've essentially answered the second question: what does an intelligent investor buy? Some might still be puzzled, wondering about other investment terms like candlestick charts and moving averages that other investment gurus frequently mention. Don't worry, Graham devotes a significant portion of his book to this, which leads us to the third question we'll discuss next: when to buy and when to sell, or in other words, trading strategies. Graham's trading strategy might not meet many people's expectations. In fact, it can be summed up in one sentence: technical analysis like candlestick charts and moving averages is utterly useless. Many might not agree with this statement, so Graham took great pains to prove that these low buy, high sell techniques are ineffective. Graham's critique of trading strategies begins with his dismissal of the Dow theory, which is what we in China often refer to as trend trading. This strategy involves interpreting a market surpassing a specific point as a breakout, followed by buying or selling actions. This method is widely used by iShare investors in China today. Graham pointed out that while Dow theory trading had yielded good returns from the late 19th century to the early 20th century, over the 30 years following 1938, returns from strictly following this method were actually lower than simply holding the Dow Jones Index. Many experienced iShare investors have also realized this. The Dow theory might seem incredible, but in volatile histories, it leads to high transaction costs due to too many false signals. Another risk of Dow theory trading is self-confirmation. When many market participants adopt this strategy, it exacerbates rises and falls. Graham noted this as dangerous. From our iShare market experience, a breakout above or below a certain point can indeed create dramatic market surges or crashes, presenting significant opportunities. However, with investment institutions now widely adopting algorithmic and even high-frequency trading, it has become very difficult for individual investors to compete in the ultra-short-term field. The second strategy Graham criticized is the simple low-buy, high-sell approach, such as buying after a significant price drop and selling after a significant rise. This strategy has faced disastrous outcomes in multiple markets globally, including the iShare market. Why? Because buying after a big drop is not about catching the bottom or guessing where the top is. Both are major taboos in investing. Graham's third criticized strategy is the city investment scheme, similar to the grid investment method adopted by some investors in our country. This involves buying in batches during a price drop and selling in batches as prices rise. Graham pointed out that investors who strictly follow this plan might leave the market with some profits, but often find it difficult to re-enter the market. This scheme only buys during downturns, so if there's a super bull market that only rises for several years, these investors can only watch the rise helplessly, unable to buy. They are, in a sense, abandoned by the market. In the iShare market, similar situations often occur when grid investors continuously sell stocks during a rise until they are fully divested, just as the market's main wave is starting. Investors adopting this strategy often miss out on the highest profits. In Graham's view, market fluctuations are not opportunities to make money but rather disturbances to intelligent investors. He posed a simple question: if the stocks you hold are rising, would you sell them? If not, then the price increase shouldn't affect your wealth, and there's no need for significant emotional fluctuations due to price changes. To overcome this emotional disturbance inherent in human nature, Graham suggested incorporating some mechanical operations into the investment portfolio, such as gradually adjusting the proportions of stocks and bonds. He pointed out that this is not for financial reasons but to give investors something to do to overcome human weaknesses. After discussing all these commonly used trading strategies by iShare investors and finding them flawed, the question remains: when should we buy and when should we sell? There must be a strategy. We can't just buy and sell blindly. So, there are two methods: timing and valuation. Timing is about choosing the right moment, while valuation involves estimating the fair value of a stock, buying when the price is below this value and considering selling when it's above. Compared to timing, Graham favored the valuation trading strategy. He pointed out that modern investors, overly focused on market trends and changes, no longer see themselves as owners of listed companies, leading them to pay little attention to the actual value of the companies. In most cases, fluctuations in stock prices reflect market sentiment rather than doubts about the company's value. It's more about skepticism over the premium between the stock price and the net assets. In other words, when market sentiment is optimistic, stock prices can far exceed their actual value, and when pessimistic, there might be irrational sell-offs, causing stock prices to fall well below their real value. This presents a prime opportunity for the intelligent investor. Simply put, adopting a valuation trading strategy means forgetting the stock market exists and focusing more on dividend returns and the company's operational status. Buy decisively when the stock price is below your assessed real value, and consider selling in batches when it's above. As for how to correctly assess the real value of a stock, one must rely on financial analysis. The latter part of The Intelligent Investor introduces some specific financial analysis methods through case studies. However, due to differences in national conditions and eras, these may be of limited help to Chinese investors. Financial analysis is a very complex task, and many investors may not have enough time to read financial reports or learn accounting skills. Here, we can refer to a simple method proposed in the book. Compare a stock's average price-to-earnings ratio over the past 7 to 10 years with the market average during the same period. A company's performance might fluctuate significantly in the short term, but the 7 to 10-year average can serve as a standard. Stocks with an average P ratio below the market level, or in other words, stocks with earnings per share above the market level, are more suitable for defensive investors to buy. For example, the average P ratio of the Shanghai Stock Exchange reached 69 in 2007, dropped to a bear market low of 9.8, and is currently 17.9. As you can see, the fluctuations are quite severe. Let's make a rough estimate. Over the past 7 years, the average P ratio has been around 15. Let's look at two stocks. Stock A currently has a P ratio of about 8, which is significantly below the market average. However, this company only performed well last year, with poor performance in the previous 6 years, where the P ratios were in the dozens or even hundreds, averaging over 40 for the past 7 years. On the other hand, stock B now has a P ratio of 15, which has been quite stable over the past 7 years, averaging around 13. According to Graham's criteria for stock selection, stock B is more suitable for defensive investors, while active investors might consider allocating a portion of their assets to companies with stronger growth potential. Graham defines growth companies as those whose growth rates in the last 2 to 3 years are significantly higher than the average over the past 7 to 10 years. A simple method proposed in the book to assess the price of growth stocks is to consider the expected annual growth rate over the next 7 to 10 years, without the percentage sign, as the reasonable P ratio for the stock. Let's look at an example from the iShares market. A startup board stock with a P ratio of 40, which is considered low and thus cheap by startup board standards. This implies an annual growth rate of 15.75. Can this company maintain an annual growth rate of over 15 for the next 7 to 10 years? Investors can judge for themselves if they are confident in this growth before buying at a P ratio of 40. In the final part of the book, Graham introduces his central idea of investing, which is the concept of margin of safety. The original term, margin of safety, refers to the difference between the market price of a security and its assessed value. The safety margin depends on the price paid. The higher the price, the smaller the margin of safety. In most cases, there are no absolutely good or bad stocks, only safe or unsafe prices. If a company is of high quality but the stock price is too high, then the investment is also unsafe. Graham wrote that his many years of observation proved that the risk of paying too high a price for quality stocks exists, but it is not the main risk faced by ordinary investors. In fact, The main losses for ordinary shareholders come from buying poor quality stocks during a bull market, such as interpreting a stock as safe because it has been thriving in the short term and profits have been high in the last 2 or 3 years. Graham does not deny that growth stocks can also have safety, but the assessment of growth stock prices depends more on future profit expectations than on calculations of historical profits. In these calculations, some people possess advanced technical skills to make relatively accurate forecasts, but the risk with growth stocks is that the market can easily form an excessive premium. The principle of diversification is also related to safety. Diversification only makes sense and truly reduces risk when the overall market is safe. Graham gave an extreme example of roulette, assuming there are 37 numbers and you bet $1 on each. Can it be profitable? No, even though you will definitely win once, the house set reward is only $35, so betting on every number inevitably results in a $2 loss per number. When investors diversify their investments in the securities market, they might consider this casino example. Finally, let's briefly summarize the main points of the book. First, all financing transactions are speculative. Second, most people are better suited to a defensive investment strategy. Only a few wealthy and leisurely individuals should try active investing. As a defensive investor, stocks should make up 25 to 75% of all investment assets, and only large financially stable companies with a consistent dividend history should be purchased. Third, even if you are an active investor, you should allocate most of your assets to these financially robust stocks while setting aside some funds to look for investment opportunities that most people overlook. In terms of trading strategy, the valuation analysis method should be adopted. Buy when the stock price is below your calculated real value and sell when it is excessively high. Fourth, be mindful of safety. When the overall market prices are too high, any diversification is unsafe. This classic by Graham has now been thoroughly explained to you. Of course, many people do not agree with Graham's views, especially in the iShare market where frequent trading techniques prevail. The underlying reason is that they do not want average returns but rather seek excessive profits. Graham has said that achieving satisfactory investment results is simpler than most people think, but achieving very good results is harder than imagined. Investing is a wisdom involving life choices, a marathon that spans decades. The path you choose not only determines your level of returns but also affects your entire life direction. That's all for today's insightful session on the intelligent investor. See you tomorrow, and thank you for your support and attention. Please subscribe to the Enjoy Audiobook channel, like, and share this valuable knowledge with your friends. Let's combine wisdom and practice to achieve our financial goals and create a better future. Thank you, everyone!